Hey y'all. Yeah. Hey y'all. Hey two people. Hey y'all. What y'all doing? I'm about to stuff my book. Put this bed up. Hey. Are you confused?
Yeah.
I know. I knew something wasn't right up there.
And you know what it is, man. What happened? Where's the work?
What work?
You know your job.
No.
You didn't go to work today?
I was off. Monday and Wednesday, I'm off.
All right. Monday, Wednesday, and Tuesday, you off. Monday, Wednesday, and Tuesday. Mm-hmm. Monday, Wednesday, and Tuesday. Mm-hmm. You're off. 3 days. Mm-hmm. So what's happening?
Nothing. I saw you call me, but I was asleep.
Oh, yes, you were knocked out. You were tired.
I know. Kevin told me that you called, but I was asleep.
Good job, Kevin. Good job. Somebody didn't answer the phone.
He was on the phone with somebody else. He ain't got to answer.
Okay. Good. He's a respectable man. Good. Mm. Well, listen, I'm just letting you know what's happened.
Oh. We're from my niece, my nephew.
Did you do this to everybody?
Hey.
Oh, you just love a big family.
Hey.
A big
I don't understand this, but hey.
Don't you have a big family of your own?
No.
Yes, you do.
No. I'm waiting for you to give me, for me to be the auntie.
So let me ask you a question. You want to be an aunt so bad. But do you do this to all your friends?
Yeah, I do.
Okay, so you just want to be you just want to be in their family. That means you want to babysit? You want to take them out? You want to babysit?
I don't know what that is.
For the right price.
Yeah.
What do all your friends say to you?
Nothing.
I said, what do all your friends say to you?
Nothing.
Yeah, but you want to be involved in their family. I'm surprised your friends say, "Maya, don't you have your own family, your own home?"
No, they don't.
They don't say, "Maya, don't you have nieces and nephews already? What more nieces and nephews do you want?"
No, because they family love me. They always ask about me. They're like, bring her over here. They love me. So, yeah, I know.
I'm different for you, man.
Good night.
Not that I'm uncomfortable or anything. I'm like,
boy, don't you? Oh,
you're like a fucking rat. You want to get your
hey.
Family and just live there forever.
Hey, like the hey. Good night.
You dream about you over and say, "Hey, Mariah, go babysit my niece. Go babysit your niece. Go babysit your uncle. Your nephew." Yeah. You whine and bitch and moan. I want that baby. I ain't doing this for free.
No, only two friends that they auntie. So it's two of them. And one of them the godmother. I'm the godmother. Yeah. So one of them I'm the godmother. The other one is the auntie.
You know why? I think because you got Chubby, you got Cairo, and you're about to have the little girl. You have nothing else to do.
I had to do it.
You have nothing else to do.
I had to.
I can't get it. I can't get it. That's just your thing. There's nobody like you. There's really nobody like you. Yeah, no money, very man. Why should I care?
I'm good. How was your Thanksgiving? My Thanksgiving was good. You? Yep. Hey. I know you about to go do the. You about to nasty with your baby mama. Okay.
Any girls this you up today?
No.
Diamond?
No.
No girls today?
No.
Jesus Christ, your thing going down.
Well, I'm gonna let you get back to your I'm gonna let you get back to your baby mom. Yeah, okay. Hey, mine was good. Okay. What's up? At? Oh, you don't know what's up? At? Okay. But yeah, mine was good. Had a lovely day. I'm just chilling. Y'all. I'm about to study for this. Actually, I don't know. They did a quiz today. I know I was tired. I know your girl was. I was tired. The girl was tired. I'm only gonna have like like, like 3 classes on different days. That's so sad. Chocolate. Yep, for next year. For my schedule gonna be for next year. It's gonna be Monday, Wednesday. What do you major in? What do you major? For my major, it's basically business and acting. That's my major, business and acting. So, that's yeah, that's my major is on business acting. So I know I didn't go to school today because I was so tired. I did laundry and I woke up. So I was like, yeah, I'm so tired right now. Just not today. Yeah, so it was like not today. Computer. There we go. But yeah, that's my major is business and acting. But, yeah, my major is business and acting. That's my major. So that's my major, business and acting. You got it over here in Spanish, then you have it in English. Which one is it? Evas. If you got 1 minute Spanish and English, thank you for the heart. What gate? You mean GTA or what gate? Then oh. This is fucking 11 minutes, 11, 30, 2:21, 12, 3 hours. Okay. So yeah, I got my schedule set for next year. Okay, just that. But I don't know. Friday. No. I don't know. I don't know. Oh, okay. What the fuck? What the fuck? They're speaking a different language. Yes, they are speaking a different language. That's why I'm like, oh, okay. I'm confused. Me too. I'm confused too. They're speaking a whole different language. Like, I don't know what language y'all speaking. Whatever language it is, I don't speak that. It's a whole different language. But yeah, what life, yeah, my business is acting and is business and acting. But yeah, they speak a whole different language. I don't know. They I'm about to read chapter 17. I don't know what chapter I started. I'm gonna read in this in the fifth day. This part I was up to. do these other ones. Only got 3 more chapters. I gotta do 18, 19, 20. But I'm probably this one. Where do you see yourself in the next 5 years? Um, maybe. For me, I don't really know. Hold on, you can stop it. I don't think but for me, where do I see myself? I I see myself having my own being. I feel like still being a creator, like still a contenter, because I love what I do, and ain't nobody gonna change that. Like ain't nobody really gonna change that. So for me, I would say a content yeah, a YouTuber, a TikToker, um I would say doing incredible stuff for y'all. Um and yeah, I'll say doing what I'm doing now, having a house, having my own car, my own apartment, some kids. I like the kids. Um I love all of that. So I would see myself in 5 years still doing what I'm doing now. Apartment, car, my own place, travel everywhere with my kids. I see all that with my kids. Like I would really travel places that I've never been, but I would like, have my kids go to different places, travel places. Like, that's something I want to do with my kids, travel. And I feel like you have to start your kids young to travel. Um, for them to get custom, like in the travel and stuff like that. So it's like I don't want them to feel like this, like you can't go some places. You can go different places, like that of course. But I would want my kids to travel and and let them have fun. Like I don't want them to have their mind grown up set on just kids or having kids. Like, I want them to explore. So it's like so there's some places I never went as a kid. Like, really, so yeah, I want my kids to have that because I love travel. So I want my kids to travel too. Basically, yeah. I hope I ain't getting sick. Okay. So yeah, I see myself having kids, having one family, and enjoying life. Enjoying life to the fullest. I would say enjoying life to the fullest. Remember that. So basically, yeah.
Apple, Coca, Cola.
But yeah, I definitely see myself like having kids, still doing what I'm doing with YouTube, TikTok. It was something that like my kids wants to do, like YouTube, TikTok. I feel like you should show your kid like, if your kids want to do what you do, like to really show your kids, different things if you use different requirements and stuff like that. So I would show my kids, but I will wait till they turn 18. Okay, I will wait till they turn 18 to show them to do YouTube because YouTube don't pay minors. Okay, and they have to use the parents have to file the taxes. That's why for me, if I had kids, I suggest to wait till your kids turn 18 so they can do their own taxes. So that's something I would do. Like I'll wait till they turn 18 and that way I know they can do their own taxes. So it's like basically yeah. Because they don't pay mine.
Chapter 17 Understanding Accounting and Financial Information 451 acquires another and pays more for it than the value of its tangible assets. Even though intangible assets such as brand names, Apple, Coca-Cola, Starbucks, etc. can be among the firm's most valuable resources, they are not listed on the company's balance sheet. They were developed within the company to Greece accountants list assets on the firm's balance sheet in order of their liquidity, or the ease with which they can convert them to cash. Speedier conversion means higher liquidity. For example, an account receivable is an amount of money owed to the firm that it expects to receive within 1 year. It is considered a liquid asset because it can be quickly converted to cash. However, is not considered a liquid asset.
But basically, yeah, that's something in 5 years.
It is considered a fixed or long-term asset. Assets are thus divided into 3 categories according to how quickly they can be turned into cash. 1. Current assets are items that can only be converted into cash within 1 year. They include cash, accounts receivable, and inventory too. Fixed assets are long-term assets that are relatively permanent, such as land, buildings, and equipment. On the balance sheet, we can also refer to these as property, plant, and equipment. 3. Intangible assets are long-term assets that have no physical form but do have value. Patents, trademarks, copyrights, and goodwill are intangible assets. Liabilities and owner's equity accounts. Liabilities are what the business owes to others its debts. Current liabilities are debts due in 1 year or less. Long-term
Thank you for liking my
life. 1 year or more. The following are common liabilities.
I'm just over here studying, y'all.
On the balance sheet.
I'm going to study.
Figure 17.4 again. 1. Accounts payable are current liabilities or bills the company owes others for merchandise or services it purchased on credit but has not yet paid for. 2. Notes payable can be short-term or long-term liabilities, like loans from banks, that a business promises to repay by a certain date. 3. Bonds payable are long-term liabilities, money lent to the firm by bondholders that it must pay back. As you saw in the fundamental accounting equation, the value of things you own, assets, minus the amount of money you owe others. Liabilities is called equity, the value of what stockholders own in the firm, minus liabilities is called stockholders' equity or shareholders' equity. Because stockholders are the owners of the firm, we also call stockholders' equity owner's equity, or the amount of the business that belongs to the owners, minus any liabilities the business owes. The formula for owner's equity, then, is assets minus liabilities. The owner's equity account will differ according to the type of organization. For sole proprietors and partners, owner's equity means the value of everything owned by the business minus any liabilities of the owner. S, such as bank loans. Owner's equity in these firms is called the capital account. For corporations, the owner's equity account is not what the owner's claims to funds they have invested in the firm, such as stock, so well as reducing savings. Retained earnings are accumulated earnings from the firm's profitable operations that are reinvested in the business and not paid out to stockholders in distributions of company profits. Distributions of profits, called dividends, are
discussed in Chapter 39. Take a few moments to look again at Figure 17.4 and see what facts you can determine about our restaurant. Hardest goal. From its balance sheet. After the test prep, have some fun and estimate your own personal net worth. Following the directions on Figure 17.5, liquidity release revision assets that can be converted into cash. Current assets, items that can only be converted into cash within 1 year. Fixed assets, assets that are relatively permanent, such as land, buildings, and equipment. Intangible assets, long-term assets, e.g., patents, trademarks, copyrights, that have no real physical form but do have value. Liabilities like a business owes to others. Debts. Accounts payable. Current liabilities involving money owed to others for merchandise or services purchased on credit but not yet paid for. Notes payable, short-term or long-term liabilities that a business promises to repay by a certain date. Bonds payable. Long-term liabilities that represent money lent to the firm that must be paid back. Owner's equity, the amount of the business that belongs to the owners minus any liabilities owed by the business. Retained earnings, the accumulated earnings. Operations that were reinvested in the business. Stockholders and dividends. Piece of bread. What do we call the formula for the balance sheet? 1-3. Accounts doesn't include. What does it mean to list assets according to liquidity? What's the difference between long-term and short-term liabilities on the balance sheet? What is owner's equity, and how is it determined? Income statement. The financial statement that shows the firm's profit after costs, expenses, and taxes. It summarizes all of the resources that have come into the firm. Revenue. All the resources that have left the firm. Expenses, and the resulting net income or net loss. Net income or net loss. Revenue left over after all costs and expenses, including taxes, are paid. The income statement. The financial statement that shows the firm's bottom line, that is, its profit or loss after costs, expenses, and taxes, is the income statement. The income statement summarizes all the resources, called revenue, that have come into the firm from operating activities. Money resources the firm used up, expenses it incurred in doing business, and resources it has left after paying all costs and expenses, including taxes. The resources, revenue left over or depleted, are referred to as net income or net loss. See Figure 17.6. The income statement reports the firm's financial operations over a particular period of time, usually a year, a quarter of a year, or a month. It's the financial statement that reveals whether the business is actually earning a profit or losing money. The income statement includes valuable financial information for stockholders, lenders, potential investors, employees, and, of course, the government. Because it's so valuable, let's take a quick look at how to compile the income statement. Then we will discuss what each element in it means. Revenue. Cost of goods sold equals gross profit. Gross margin. Operating expenses equals net income before taxes. Taxes equals net income or loss. Revenue is the monetary value of what a firm received for goods sold, services rendered, and other payments, such as rent received, money paid to the firm for use of its patents, interest earned, etc. Each firm includes revenue and sales. They are not the same thing. True, most revenue a business earns does come from sales, but companies can also have other sources of revenue. Also, a quick glance at the income statement shows you that gross sales refers to the total of all sales the firm completed. Net sales are gross sales minus returns, discounts, and allowances. 454 Part 6 Managing Financial Resources. Cost of goods sold, or cost of goods manufactured, a measure of the cost of merchandise sold or cost of raw materials and supplies used for producing items for resale. Gross profit, or gross margin, how much a firm earned by buying, or making, and selling merchandise. Operating expenses, costs involved in operating a business, such as rent, utilities, and salaries. Depreciation, the systematic write-off of the cost of a tangible asset over its estimated useful life. Most businesses incur operating expenses including rent, salaries, utilities, supplies, and insurance. What are some of the likely operating expenses for companies like Starbucks? Cost of goods sold NaNCH or the sue from on make me an outing item for much of red cents to cook pound euro and the pre-spelling mechanism he price PHT such a make or buy or deny the odd bonus and purchase so at any freight charges paid. Where can be the odd costs associated with storing them in financial reporting in or slots, plus Abby Tran places a particular BI's inventory, but I was minor I do review the cost of the item when pair of inventory valuation methods, LIFO and FIFO and then. Wow. To understand, read the spirit on small business talks about two different when we subtract the cost of goods sold from net sales. We get the firm's gross profit or gross margin. Gross profit or gross margin is how much a business earned by being sold or making and selling merchandises while serving as item. There may be no cost of goods sold. Therefore, gross profit could equal net sales. Gross profit, however, does not tell you everything you need to know about the firm's financial performance. To get that, you must also subtract the business's expenses. Operating expenses in selling goods or services. A business incurs certain operating expenses such as rent, salaries, supplies, utilities, and insurance. Other operating expenses that appear on an income statement, like depreciation, are a bit more complex. For example, have you ever heard that a new car depreciates in market value as soon as you drive it off the dealer's lot? The same principle holds true for assets such as equipment and machinery. Depreciation is the systematic write-off of the cost of a tangible asset over its estimated useful life. Under accounting rules set by GAAP and the Internal Revenue Service which are beyond the scope of this chapter, companies are permitted to recapture the cost of these assets, i.e., cars, computers, machinery, office and electronic equipment, over time by using depreciation as an operating expense. We can classify operating expenses as either selling or general expenses. Selling expenses are related to the marketing and distribution of the firm's goods or services, such as advertising, salespeople salaries, and supplies. General expenses are administrative expenses of the firm such as office salaries, insurance, and rent. Accountants are trained to help you record all applicable expenses and find other relevant expenses you can deduct from your taxable income as a part of doing business. Net profit or loss after deducting all expenses. We can determine the firm's net income before taxes, also referred to as net earnings or net profit. See figure 17.6 again. After allocating for taxes, we get to the bottom line, which is the net income, or perhaps net loss the firm incurred from revenue minus sales returns, costs, expenses, and taxes over a period of time. We can now answer the question: did the business earn or lose money in a specific reporting period? As you can see, the basic principles of the balance sheet and income statement are already familiar to you. You know how to keep track of costs and expenses when you prepare your own budget. If your rent and utilities exceed your earnings, you know you're in trouble. If you need more money, you may need to sell some of the things you own to meet your expenses. The same is true in business. Components need to keep track of how much money they earn and spend, and how much cash they have on hand. The only difference is that they tend to have more complex problems and a good deal more information to record than you do. Spotlight. Open spotlight on small business, the ins and outs of inventory, generally accepted accounting principles. GAAP sometimes permit an accountant to use different methods of accounting for a firm's inventory. Two of the most popular treatments are called FIFO and LIFO. Let's look at a simple example. Say your college bookstore buys 100 copies of a particular textbook in July at $150 a copy. When classes begin in mid-August, the bookstore sells 50 copies of the text to students at $175 each. Since instructors intend to use the same book again next term, the bookstore places the 50 copies it did not sell in its inventory until then. In late December, the bookstore orders 50 additional copies of the text to sell for the upcoming term. However, the publisher's price of the book to the bookstore has increased to $175 a copy due to inflation and other increased production and distribution costs. The bookstore now has in its inventory 100 copies of the same textbook, purchased during 2 different buying cycles. If it sells 50 copies to students at $200 each at the beginning of the new term in January, what's the bookstore's cost of the book for accounting purposes? Actually, it depends. The books sold are identical, but the accounting treatment could be different. If the bookstore uses a method called first in, first out, FIFO, the cost of goods sold is $150 for each textbook. Because the textbook the store bought the first in cost $150, the bookstore could use another method. However, under last in, first out, LIFO, its last purchase biology, anatomy, physiology, biology, Sylvia S. Mater, microbiology, a Truman perspectival Keo biology, and physiology, Gracegorgeous I microbiology, A systems approach 18.7 of the textbooks, at $175 each, determines the cost of each of the 50 textbooks sold. If the book sells for $200, what is the difference in gross profit margin between using FIFO and using LIFO? As you can see, the inventory valuation method used makes a difference in the profit margin. Mark Dierker, McGraw-Hill Education. Users of financial statements are interested in how a firm handles the flow of cash coming into a business and the cash flowing out of the business. Cash flow problems can plague both businesses and individuals. Keep this in mind as we look at the statement of cash flows next. The statement of cash flows. The statement of cash flows reports cash receipts and cash disbursements related to the 3 major activities of a firm. Operations are cash transactions associated with running the business. Investments are cash used in or provided by the firm's userent activities. Financing is cash raised by taking on new debt, or equity capital, or cash used to pay business expenses, past debts, or company dividends. Accountants analyze all changes in the firm's cash that have occurred from operating, investing, and financing in order to determine the firm's net cash position. The statement of cash flows also gives the firm some insight into how to handle cash, better said that no cash flow problems occur, such as having no cash on hand for immediate expenses. Figure 17.7 shows a sample statement of cash flows, again using the example of our restaurant harvest goal. As you can see, the statement of cash flows answers such questions as: statement of cash flows, financial statement that reports cash receipts and disbursements related to a firm's 3 major activities: operations, investments, and financing. 455. 456. Part 6, Managing Financial Resources. Part 6, Managing Financial Resources. Lonnie McWhorter owns a gas station that works with local suppliers to provide customers with healthy, organic food instead of the typical convenience store fare. In 2007, he took out an $875,000 loan to purchase the property and gas pumps. His business, 36 Lynn Refuel Station, now brings in millions of dollars annually in gross revenue. What is the difference between revenue and profit? How much cash came into the business from current operations, such as buying and selling goods and services? Did the firm use cash to buy stocks, bonds, or other investments? Did it sell some investments that brought in cash? How much money did the firm take in from issuing stock? We analyze these and Anthony Sufel Start Review Getty Images, other financial transactions to see their effect on in more depth in the next section. The firm's cash position. Managing cash flow can mean success or failure of any business, which is why we analyze it. The need for cash flow analysis. Cash flow, if not properly managed, can cause a business much concern. Understanding cash flow analysis is important and not difficult to understand. Let's say you borrow $100 from a friend to buy a used bike and agree to pay them back at the end of the week. You then sell the bike for $I50 to someone else, who also agrees to pay you by the end of the week. Unfortunately, by the weekend your buyer does not have the money as promised, and says they will have to pay you next month. Meanwhile, your friend wants the $100 you agreed to pay them by the end of the week. Making. Less than per. FUCT. Making ethical decisions less than perfect accounting fastb.org. After graduating with a degree in accounting, you accept a job at a small producer of premium cat food called Top Cat that sells directly online. A distribution problem and supply disruptions due to COVID-19 caused many of the company's customers to shift to competitors' brands. Fortunately, over the past year, many of the firm's previous customers are returning and things are looking up. The problem is the company's cash flow has suffered during the past few years, and the firm needs immediate funding to continue to pay its bills. Company executives have prepared a proposal to a local bank for a loan to keep the company afloat. Unfortunately, you know that Top Cat's financial statements for the past few years will not show good results. You expect the bank will not approve the loan based on the current financial information, even though the firm seems to be coming back. Before you close the books for the year, the CEO suggests you might improve the company's financial statements by treating the strong sales made at the beginning of January of the current year as if they were made in December of the past year. You know this is against the rules of the Financial Accounting Standards Board, FASB, and refuse to alter the information. The CEO warns that without the bank loan, the business is likely to close, and everyone will be out of a job. You know the CEO is right and also know that many of the firm's employees will be let go and will have difficulty finding new jobs. What are your alternatives? What are the likely consequences of each? What will you do? What seemed a great opportunity to make an easy $50 profit is now a cause for concern. You owe $100 and have no cash. What do you do? If you were a business, you might default on the loan and possibly go bankrupt, even though you had the potential for profit. It's possible for a business to increase its sales and profits yet still suffer cash flow problems. Cash flow is simply the difference between cash coming into and cash going out of a business. Poor cash flow constitutes a major operating problem that many companies face. For example, When Tesla CEO Elon Musk purchased social media platform X for $44 billion, he found the company faced formidable cash flow problems. Musk decided to close the company data center, reduce its cloud services by 40%, and lay off thousands of employees to address the problems. The company solved its cash flow woes and today is expecting to become cash flow positive in the near future. 3 problems with cash flow are particularly difficult for small and seasonal businesses since they have less access to capital than large companies. Cash flow can also create some tough ethical challenges for accountants in reporting the flow of funds into a business. Read the Making Ethical Decisions box to see how such an ethical dilemma can arise. How do cash flow problems start? Often in order to meet the growing demands of customers, a business buys goods on credit, using no cash. If it then sells a large number of goods on credit, getting no cash, the company needs more credit from a lender, usually a bank, to pay its immediate bills. If a firm has reached its credit limit and can borrow no more, it has a severe cash flow problem. It has cash coming in at a later date, but no cash to pay current expenses. That problem could, unfortunately, force the firm into bankruptcy, even though sales may be strong, all because no cash was available when it was most needed. Cash flow analysis shows that a business's relationship with its lender is critical to preventing cash flow problems. Accountants provide valuable insight and advice to businesses in managing cash flow, suggesting when SCI cash and how much. They also ensure that the Prospirem statements, its balance sheet, income statement, and staff visit of cash flows are properly prepared and form the basis for the firm's financial analyses. Accounting errors, manipulations, misstatements can be costly for companies. Illinois Shipping and Logistics Company Roadrunner was charged by the SEC cash flow, the difference between cash coming into and cash going out of a business. Cash flow is the difference between money coming into and going out of a business. Careful cash flow management is a must for a business of any size, but it's particularly important for small businesses and for seasonal operations like ski resorts. Have you read about any firms that were forced into bankruptcy because of cash flow problems? Noah Clayton, Tetra Images, Brand X Pictures, Getty Image. 457. FECT. Making ethical decisions less. resources. Part 6 Managing Financial Resources. With multi-year accounting fraud in his operations, the company's chief financial team is sentenced to 2 years in federal prison and the company paid $20 million in settlements. After the test prep, we will see how accountants advise companies through analyzing the financial statements using ratios. Prep, what are the key steps in preparing an income statement? What's the difference between revenue and income on the income statement? Why is the statement of cash flows important in evaluating a firm's operations? Ratio analysis, the assessment of a firm's financial condition using calculations and interpretations of financial ratios developed from the firm's financial statements. Law 17.4 demonstrate the application of ratio analysis in reporting financial information. Analyzing financial performance using ratios, the firm's financial statements, its balance sheet, income statement, and statement of cash flows form the basis for financial analyses performed by accountants inside and outside the firm. Ratio analysis is the assessment of a firm's financial condition using calculations and financial ratios developed from the firm's financial statements. Financial ratios are especially useful in comparing the company's performance to its financial objectives and to the performance of other firms in its industry. You probably are already familiar with the use of ratios in sports. For example, in basketball we express the number of shots made from the foul line with the ratio shots made to shots attempted. In baseball we use the ratio number of hits to the number of at-bats. You don't want to foul a player who shoots 85% from the foul line or pitch to a .375 hitter in a close game. Whether ratios measure an athlete's performance or the financial health of a business, they provide valuable information. Financial ratios provide key insights into how a firm compares to other firms in its industry on liquidity, amount of debt, profitability, and overall business activity. Understanding and interpreting business